Good afternoon. I'm State Representative Peterson from Wisconsin, and welcome to the National Conference of State Legislators Business Interruption Insurance and Pandemics webinar today. The COVID-19 pandemic has affected millions of Americans and businesses, especially businesses who have been forced to close to slow the spread of the coronavirus. One of the most critical areas in the insurance world right now is business interruption insurance, which helps replace lost income and cover expenses when a business is impacted by events covered in the insurance contract. Some policies specifically exclude pandemics as one of the types of events that are not covered, while others have more ambiguous language. Where does the issue currently stand? Good afternoon, and thank you for joining us once again. On this business interruption insurance and pandemics to discuss recent state legislation and federal proposals to create a recovery fund or federal backstop. My name is Representative Kevin Peterson, and I'm the co-chair of the Insurance Task Force. And I'm joined shortly by my Representative Brian Patrick Kennedy, who's having a little bit of technical difficulty logging on right now. We'll be your moderators for today. Before I introduce our speakers, I want to review a few housekeeping items. Today's webinar is a platform for information exchange and engagement. Over the next 60 minutes, we encourage participation through our chat box, so feel free to type your questions and answer any questions in the chat box on your screen. To learn who is on the line today, I invite you to type in the state from which you are calling now. We will hold a formal question and answer after our presenters are finished presenting. Many of you will want to download the slides for today's webinar. You can find a PDF version of the slides by opening the tab labeled Resources. The tabs are found just above the presentation window. Another tab is labeled Speaker, where you can read the bios of today's speakers. You can access these tabs at any time during the presentation. If you have any trouble downloading the presentation, please email Heather Morton, our NCSL Insurance Task Force staff, at heather.morton@ncsl.org, and she will send you the deck of slides. The webinar platform we are using is optimized for use in Google Chrome. We recommend anyone experience technical difficulties try signing in through Chrome instead. If you continue to experience technical issues, please email registration@ncsl.org, where our team is ready to assist you. Today's webinar is being recorded and will be available on NCSL's website within the next week. The National Conference of State Legislatures is the country's most trusted bipartisan organization, serving legislators and staff for more than 40 years. We promote a policy innovation, create opportunities for lawmakers to share knowledge, and ensure state legislatures have a strong, cohesive voice in the federal system. We do this because we believe in the importance of legislative institution and know when states are strong, our nation is strong. NCSL developed a webpage to house our comprehensive resources on the state and federal response to COVID-19. Here you can find a database with up-to-date, real-time information about bills related to and responding to COVID-19 that have been introduced in the 50 states, Puerto Rico, Guam, and the District of Columbia. Archives of previous webinars, information on state policies in response to related continuity of government, and other important considerations during this unprecedented time. Now that the housekeeping details are out of the way, let's get back to why we are here today. Joining us today are Don Griffin, Department Vice President of the American Property Casualty Insurance Association, Leon Buck, Vice President of Government Relations, Banking, and Financial Services for the National Retail Federation, and Richard Gibson, Senior Casualty Fellow at the American Academy of Actuaries. First up, we have Richard Gibson, Senior Casualty Fellow at the American Academy of Actuaries. Richard is a property casualty actuary with nearly 40 years of actuarial experience. He serves as the actuarial profession's chief public policy liaison on property casualty issues and communicates the Academy's work on casualty actuarial issues, including cybersecurity, extreme events and climate risk, workers' compensation, medical professional liability, automobile insurance, and many more issues to public policymakers in the public. Rich, thank you for joining today. The floor is now yours.
Thank you, I appreciate it very much. And on behalf of the American Academy of Actuaries, let me say thanks to the National Conference of State Legislators for inviting us to participate. I thought I would start with a bit of background about the American Academy. As you can see there, our mission is to provide objective and independent advice to policymakers on matters relevant to actuarial practice. The Academy is a national organization for actuaries in the U.S. It's made up of actuaries practicing in multiple practice areas: pensions, life, health, property, and casualty insurance. My comments today will be from an actuarial perspective. As we think about the broad public policy issues around business interruption coverage, the Academy is certainly aware and sympathetic to the challenges that the pandemic has placed on the nation's small businesses. Similarly, we are aware of the challenges it would take to ensure such a broad catastrophic event. We certainly have monitored the active proposals around BI coverage. We have not specifically endorsed one or another of the proposals. That said, we have provided commentary to the House Financial Services Committee regarding HR 711. The link to that testimony is shown there in the slides, and you can follow up on that for more details. So as we think about general considerations from an actuarial perspective, what this slide shows is what it takes to develop and manage any private insurance program or mechanism. So I'll throw out a little bit of actuarial lingo here, and hopefully this is as deep as I have to go with it, but we always strive to have an actuarially sound program. And what it takes to be actuarially sound is that rates must consider all the expected value of all future costs of the program. So by nature, rates are prospective in nature, and they're estimated prior to knowing the actual costs. Typical costs of an insurance program are claims costs and expenses to run the program. And I've made special note here on the slide to the cost of capital. The capital that is required to support the program in case the actual costs are higher than expected. Obviously, volatility plays a key role here because we are still predicting the future, and if a particular type of coverage is more volatile, it will be harder to estimate. So continuing with just some general considerations, no surprises here, but catastrophic events are harder to estimate and fund prospectively. Geographically, they are typically geographically localized and occur over a short period of time, but they can be a very low frequency, but very high severity and magnitude. Pardon me while I get on the correct slide, folks. So as we move further into the discussion, What are some of the considerations for insuring pandemics, and how is that different? So characteristics of the pandemic, clearly it's catastrophic in nature. It's definitely has not been localized in time or place. And I apologize that my slides are moving around on me. So accurately estimating an actuarially sound rate may not be possible. We're all painfully aware that the effects of the pandemic have been catastrophic, that it has been national in scope and has extended over a lengthy period of time. So even though some statistical and analytical methods have become ever more advanced over the last several years, we still have to wonder whether or not we can accurately estimate a sound rate for a program of this nature. Consequently, affordability would be questionable as well. Capital required to support a private insurance market program could be quite large, and it would be perhaps unreasonable for the insurance industry to carry that much capital. Additionally, while we've talked about financial capacity, it's possible that operational capacity to settle all claims may not be available. So carrying this a little further, magnitude of losses from a pandemic is large, and a federal backstop is likely to be necessary. So as we think about this, we need to start thinking about what are some of our goals. In designing a program, we need to consider how fast you want to get funds into the hands of small business. BI claims, as the coverage is normally structured, are complex, so that slows the process. Affordability is a key issue. Absent a robust backstop, industry capital is exposed, and it could lead to heavy risk charges. Clearly, if it is not affordable, the number of businesses buying the coverage would be reduced, so the uptake would be less than desired. So just wrapping up here on considerations, we need to think about the nature of the coverage that we want. As I mentioned, business interruption is a complex coverage. We have to think about how we want that coverage to look for a pandemic. We also need to be clear about what our overall goals of the program are. How quickly do we want to get money into the hands of the small businesses? Should they have to shut down because of the pandemic? Many technical considerations to go into this. So just as my last slide here, I've shown you here my contact information, and happy to hear from any of you should I have left something to be less than perfectly clear. Thank you again, and look forward to your questions later.
Thank you, Rich. What we'll do is ask members that are on the webinar, if you want to put your questions into the audience chat box. We will cover them at the end after all the presentators have spoken. But thank you again, Rich, for your presentation today. Next up, we have Don Griffin, Department Vice President with the American Property Casualty Insurance Association. APCIA is the largest property and casualty insurance trade association with over 1,200 member companies nationwide. He is APCIA's point person on catastrophic and flood insurance issues and has helped lead the organization's policy-related pandemic response. Thank you for being here today, Don.
Thank you, Representative Peterson. I appreciate that. And thank you, Representative Kennedy, as well, for this opportunity to be here. And thanks to all of you that have dialed in for this today. Following on Richard's comments, I'm going to see if I can reinforce some of those as well. APCIA, just real quickly, is I don't have any slides, so apologize for that, but hopefully you can hear me talk and do a few things that way. APCIA, as mentioned, is the largest trade association. We have roughly 60% of all the marketplace in the United States. And we have some very large writers down to some very small one state or very specific line writers throughout the country. We are the product of a merger, as I was about to mention, between the AIA and the PCI back in 2019. So we're now entering our third year as a combined organization. When we looked at the idea of business interruption coverage and all the things that have happened since, first of all, I'd be remiss if I didn't say that we certainly appreciate the fact that this has been a horrible event for our country, for the nation, and the world. The number of people that have lost their lives is just incomprehensible. And we, as the insurance industry, feel we have a part to play, but it might be a slightly different part than most people would think related to insurance. When we look at the numbers, we've seen that just the U.S. government alone has allocated over $3 trillion in the past few months, or almost a year now, to pay for losses due to the pandemic. There's also another $2 trillion pending, as you know, that the new Biden administration is trying to get passed so that there be more financial relief to businesses and consumers. So far, what we've seen is that Credit Suisse just came out with something last week that says there were $7.2 trillion of losses already around the world. There are some that feel that the worldwide losses are going to be as much as 12 trillion or more. That's from the International Monetary Fund. And that we, as an industry, even though there's not much coverage for pandemic, it varies from country to country, as well as from policy to policy. But we do expect there to be over $203 billion in insurance losses. So what does that mean? How do we put that in perspective? Well, if you remember, I was talking about trillions of dollars earlier. The entire surplus of the property casualty industry is about $860 billion with a B dollars. When we did early estimates of this, we figured out that the U.S. alone could be losing as much as $1 trillion a month if all businesses were closed and everybody was shut down. That would obviously not be with 860 some billion in surplus, we wouldn't have enough money to pay for even one month of losses as they would be for if they were all shut down. So let me put it in a bit different perspective. The worst natural catastrophe that has ever been, insured-wise, was Hurricane Katrina in the U.S. It cost about $54 billion. So again, we're trillions of dollars into the red in this one, and the most we've ever paid is $54 billion from one event. U.S. business interruption premiums for last year were about $2.4 billion, so that's not a lot either. The other thing I'd point out is if you think about the horrible events of September 11th, the events from COVID-19 are the equivalent of about a 9/11 event from an insurance standpoint every other day for months. So that's not something that anybody can really afford to do. So we talked about and tried to figure out, and Richard had pointed out as well, how can we deal with this? And the NAIC even testified to Congress about May of last year that insurance works well and remains affordable when a relatively small number of claims are spread across a broader group. It is therefore not typically suited for a global pandemic where virtually every policyholder suffers significant losses at the same time for an extended period. So that's one of the key things we think is important. And Richard mentioned this also. We don't have, he talked about there being volatility. This has certainly been a volatile issue. We've also looked at the fact that it's not localized. It's a significant duration. We're entering the second year of it now. And while there is a vaccine, or several vaccines, I should say now, and hopefully we will all get vaccinated for that very soon, there are variants. We'll have to see how that works. We don't know how long this is going to continue. So communicable diseases are something that we don't feel, and our members do not feel, are insurable events. The magnitude is just too great. We typically insure for fortuitous events, something that happens quickly, is over fairly quickly, and we spread the risk, as was mentioned by the NAIC. One of the things here, there's no risk, there's no way to spread this risk. One of the things we're insuring, and in fact, we had developed a program that had a trigger that was triggered based on a government closure. But one of the things we've also found out recently is when we started looking at the numbers, which we have a lot more detail now, moving into the future, and from the past year, we've realized that business closures by governments are not necessarily the only way that the small businesses and large businesses are being impacted. We've certainly seen an impact to our economy for states and areas that have not been closed. We've seen impacts to businesses that were considered essential and remained open: hospitals, car repairs, restaurants. Those have still been impacted financially, and yet there's not a government closure. In fact, in some states and some countries, there were no closures at all. And when we looked at that entirely, in its entirety, we figured out that there's not a huge difference between those areas of the country or countries that were closed due to government order and shutdown requirements versus the economic losses that also impacted countries and states that were not closed. So it becomes difficult without there being a direct physical loss to the property to insure something that is really built on fear, well-founded fear, because people are afraid that they will perhaps get the COVID-19, and it could be life-threatening. But it's not typically what we consider in the insurance industry, it's at least on the property casualty side, an insurable risk. So what our industry has started doing, they've put in a lot of exclusions. Many of the exclusions were already there. Most companies, insurance companies, have used exclusions since the SARS epidemic, which those exclusions have been put in since about 2006. So they're not old, or they're not new, let's put it that way. They are old. And before that, those exclusions were actually put in to kind of clarify that there really was no premium collected or charge made for pandemic losses or viral losses. So what do we do about this going forward? As I mentioned before, our industry has $860+ billion in surplus, which is not going to be enough to pay for these losses long term, or even short term, frankly. So we feel that the states can't do a whole lot because I'm not sure about most of the states that are represented on the call, but I can tell you the great state of Illinois, which I reside, they've just put forth a $3 billion deficit budget, and they don't have the money or the wherewithal to pay for all this themselves. So then it becomes likely, and most states will be in similar situations because of the costs of these that they've had to deal with during the pandemic. So where does the money come from? It will probably have to be a federally backed program, as Richard mentioned, heavily subsidized, because we need to make it affordable. Most insurances for small businesses cap out at about one of the most expensive lines that they buy is workers' compensation insurance. That runs somewhere between 1.8 and 2% of the business's revenues for a year to pay for that coverage. We've done some early estimates and looked at various programs, and we've seen that this type of coverage, even with a federal subsidy, could cost somewhere between 2 and 8% of business revenues. Most small businesses would not be able to afford that on their own, so subsidies need to be part of the program. The other thing that we need to do is to make sure that people can get these funds quickly. We believe, and I think that we put forth, and I know that many others have copied this since then, that there needs to be what we call a parametric trigger. So that works a little bit differently in insurance in that it does not require that you have a proof of loss before you collect the money. Basically, you purchase the protection, and if certain events are triggered, then the checks begin to flow. The proposal we had put forth would actually probably get folks money within a week or less, because the design was that people would make this purchase decision of a financial backstop for their business at the time they buy their other insurance, if it was affordable. They'd know how much they were going to get. They know how long they'd get it for. And then when something happens to trigger that event, and that's where the trigger is different now, perhaps, then the money would come in, be automatically deposited because it would all be set up earlier. It would automatically deposit it in their account, their financial accounts. So they would have access to it in order to keep employees paid and on staff. So one of the things that we think is important is, and you've heard this too from Richard, is that normal business interruption coverage takes a long time to settle. And in fact, a lot of times the business is back up and running before the financial amounts are paid, depending upon how severe their physical damage loss. If there was a fire and they've been able to get back, it was a small fire, they were able to get back in business fairly quickly. A lot of times that business will be back operational and will be paid for a certain period of time for the time that they were closed, but that'll happen after they already start back in operation. So we need to do something that gets, and we believe parametric coverage would help do that. We need to get something put in place quickly. It needs to be affordable for small businesses and large, and it needs to be something that will be bolstering to the economy. And for our industry, when we've looked at this, we're willing to help. We're willing to help sell the coverage. We're willing to help sure that whenever there are payments to be made, we can get those processed quickly. We are very well positioned to do that. But we need to think of it more as the policyholder or the paycheck protection program that the government put in place, and what that might look like if Congress had had more time to develop a robust program ahead of time. So with that, I'll stop and thank you very much and say that we're willing to help. We want to help, but the financial wherewithal to do this can only reside with a heavily subsidized product from the federal government. And Representative Peterson, I'll turn it back to you. Thank you.
Thank you, Don, for your presentation. Remember for the audience to please submit any questions you have by typing them in the chat box in the lower left corner of your screen. Our final presenter is Leon Buck, the Vice President of Government Relations, Banking and Financial Services at the National Retail Federation. The National Retail Federation represents the retail industry, a diverse community with thousands of leading retailers and industry professionals. Leon, I turn it over to you.
Well, thank you, Representative Peterson, and thank you, Representative Kennedy, and thank you to the National Council of State Legislatures. What an honor it is for me to be on here today to represent the National Retail Federation. Just wanted to sort of give everybody a brief overview of who we are and what we've done. And the National Retail Federation is a trade association that represents practically all of retail. And that includes Walmart, Target, Dick's Sports, Best Buy, Nordstrom's, Macy's. And then we also work with the state retail association organizations that represent small businesses. So retail sales and jobs have been virtually devastated by this pandemic. This is not only a health crisis, but it's a dire economic crisis. And retail sales during even 1 month were down 16.4%. The National Retail Federation is estimating that retailers will lose $730 billion in just 3 months. And over the course of a year, we have lost $1.5 trillion. We are in full support, and we have worked very hard with Congresswoman Carolyn Maloney, Congresswoman Maxine Waters, the chairman of the House Financial Services Committee, to work and establish the Pandemic Risk Insurance Act, which will establish a federal program that would help businesses obtain insurance coverage for pandemics, modeled on a program for terrorism insurance, which was immediately enacted right after 9/11. When businesses could not obtain coverage for acts of terrorism after 9/11, Congress did step in. It is time for Washington to do the same for pandemics. Retailers and other businesses across the country have seen unprecedented losses related to COVID-19 that were not covered under most current insurance policies and won't be covered if there's a second wave of the virus. At this point, it's virtually impossible to obtain pandemic coverage for the future. But a federally insured pandemic risk insurance program will provide businesses of all sizes the certainty that they need and to help build financial and economic confidence. Coverage against pandemics could be crucial as retailers seek to renew leases, invest in real estate, order inventory, plan for capital improvements, and hire or rehire workers in the coming months. A federal program could also provide a mechanism for immediate and predictable economic recovery should the nation face a pandemic, even one of lesser magnitude in the future. The National Retail Federation strongly believes, and we are working with Congress to enact this law, because we do believe that this risk is indeed insurable. It is a mandatory program. It is not a program that insurance companies have to enter into. It is also a trigger, which means that only losses, the program only goes into effect after a certain amount of money, which is $250 million, after losses have been sustained in $250 million. And it has a cap of $750 billion. So this is not an endless program that will go into the 20s and the 30s and the hundreds of trillions of dollars. And it won't function like that. It will function just like the Terrorism Risk Insurance Program. While the Terrorism Risk Insurance Act is a model, we really don't have any tests to see because we have not had another terrorism act which has allowed the TRIA, the Terrorism Risk Insurance Program, to kick in. But we believe that this is certainly an insurable risk. And indeed that there are insurance companies who are supportive of this effort. The Chubb Insurance Company, Farmers Insurance Company, Marsh McLennan, which is a huge insurance broker. So we have large insurance organizations who are behind this proposal. Just want to go over, there are key components of Chubb's pandemic business interruption program, and the program basically has two elements. One is the program for small businesses that would provide an immediate cash infusion when a pandemic is declared, and a separate voluntary program for medium and large businesses with losses. Both depend on the federal government assuming a substantial percentage of the risk through direct U.S. Treasury funding to insurers for the small business program. And we estimate an aggregate, there will be, like I said before, an aggregate limit of $750 billion in two layers. The first layer is $250 billion with the industry share of $15 billion. And the second layer is up to $500 billion excess of the $250 billion layer, which is 100% funded by the federal government. The bill, which was as written, would be 95%, would provide 95% coverage by the federal government through the Department of the Treasury. The Treasury Department would have to certify that this is indeed a global pandemic. And so after that certification process took place, then the program would then take into effect. So this, we do have a great deal of support in the Congress. We feel that this will move throughout the Congress in 2021. We also have the backing and not full support, but certainly the backing and the interest of the new Biden administration. And we'll be meeting with Treasury Secretary Yellen and through the months to come. So we believe that this is really the only solution. I mean, the other proposal that I think that has been previously discussed really is a unlimited grant program, and which really has no support, because it's an unlimited program that would just keep paying out, and really had no defined amount or limit as to how much it would even cost. So that would conclude my presentation today, and certainly take any questions. Thank you all.
Thank you, Leon. We now have 15 minutes or so for questions. Remember to please submit any questions you have by typing them in the chat box in the lower left corner of your screen. For the question and answer portion, I would like to turn this over to the NCSL, my co-chair, Brian Patrick Kennedy, and I will turn it over to him at this point. Are you with us, Brian? Okay, while we wait for Representative Brian Patrick Kennedy, who's having some technical issues, we have a few questions that have already been submitted, but don't forget, once again, if you have a questions, please type it into the audience chat box. Any questions not answered on today's webinar will be answered via email. One of the questions we got during the presentation for any of the presenters, what would be the impact of mandating retroactive BI coverage?
This is Don Griffin, Representative, if I could take that one. I think what the retroactive would be is that it would bankrupt the insurance industry, plain and simple. When we talked about it earlier, the cost of the events so far has been, even you heard from Leon, I believe, $1.5 trillion just on the retail side of business. Our industry has, as I mentioned earlier, $860 billion. While that sounds like a lot of money, that also, all that money is to be used, all that surplus needs to be available to pay for other workers' comp claims, car accidents, fires, anything else that you normally buy insurance for. And if you used all the funds to pay for a pandemic, then no funds would be available to pay for those kinds of losses. Thank you.
Yeah, I'd also like to say that we have supported a prospective solution going forward rather than retroactive, because we just that would be. I think Don is right on that score. It would just be an unlimited amount of money that there would be no accounting for. But we certainly look forward to supporting and moving this prospective solution going forward.
So I would just reiterate the comments of the other two presenters. The financial capacity just doesn't exist to support retroactive coverage.
Okay, thank you. The next question that we received is for Rich. You mentioned technical issues regarding HR 7011 in your presentation. Can you elaborate, please?
Sure. So in our correspondence with the HFSC, we raised a number of technical issues. And if you follow the link that I provided, you can see a full list of those. I mentioned a few of them in my presentation, specifically the issue of financial capacity, the issue of operational capacity, the nature of the coverage, the speed of claim settlement. A few others that I didn't mention, scope of industry participation. How do we get that nailed down? I mentioned a few of them in my presentation, specifically the issue of financial capacity, the issue of operational capacity, the nature of the coverage, the speed of claim settlement. So a few others that I didn't mention, scope of industry participation. How do we get that nailed down? I mentioned a few of them in my presentation, specifically the issue of financial capacity, the issue of operational capacity, the nature of the coverage, the speed of claim settlement. A few others that I didn't mention, scope of industry participation. How do we get that nailed down? I mentioned a few of them in my presentation, specifically the issue of financial capacity, the issue of operational capacity, the nature of the coverage, the speed of claim settlement. A few others that I didn't mention. So hopefully that was a very thorough answer now that it got repeated several times. Just a couple other points. I mean, how would the, what is the size of the federal backstop, and is it sufficient? How would the coverage work if the pandemic if the pandemic spanned more than one policy period?
Well, you know, there is a cap on the program, as I mentioned before. It's a $750 billion maximum limit. So that's when losses and payouts would cease.
Yeah, Leon, I understand. The question that we had was whether that would be sufficient, given the size and scope of the losses relative to the pandemic. And I realize there's a concern around, gee, how big can this thing get?
Yeah, well, unfortunately, it's sufficient to what we have now.
Well, it's way more efficient than what we have now. I agree with that, certainly.
This is Don, but I'd just like to add, though, the one thing about that is that, you know, that is a concern when we were looking at this, is how, if you put a cap on it, which both the Chubb and PREA and several other programs that have been considered do have, and you need to have that because there needs to be some reasonableness of it. The problem is if it's, you know, Leon has mentioned that the Retail Association has already experienced double those losses in the year. So that means that if it was written the way TRIA is, which I believe it is, those people would get 50 cents on the dollar for whatever they purchased under the program, because they'd get, and sometimes then you have to figure out, do they have to wait until they see all the claims to pay the people? Otherwise, there's a rush to the courthouse steps or a rush to get your claim in early so you can make sure you get paid under the cap, or do they have to try and get the money back later if there's not enough? So there are some problems with that, and I think that's what Richard was alluding to with part of the problems.
Well, yeah, just fundamentally, I'm not suggesting that these technical considerations make this an unviable program. It's just simply issues that need to be addressed and considered in great detail to understand the mechanism and how they work. I mean, Don raises a good point. What happens if somebody gets fully funded for their losses and someone else doesn't?
Well, let me point out that this money doesn't come out of thin air. This operates like a normal insurance program where where insurers pay monthly premiums, and they pay into the program. They also pay a deductible before they collect. So there will be money by companies who are insured to pay into the program.
Okay, as a follow-on to that, we have a question that came in. It kind of dovetails into there. With less than half of businesses purchasing BI coverage, are there options or suggestions to encourage businesses to add this coverage to even cover non-pandemic disasters?
This is Don Griffin, Representative Peterson. I'd be happy to take the first stab at that. There are options. Most small businesses have what they call a business owner's policy, and that policy automatically includes some lost income and extra expense and other things related to business interruption. As the businesses get larger, though, and that's, more than 90% of those policies have that built in. The policy itself is written almost like a homeowner's. It's for the business itself, for the liability that arises out of it, and for being shut down because you've had some kind of actual physical loss. So that part is already in those policies for small businesses, for those that have that coverage. As the businesses get larger, they can't always buy what they call a business owner's policy, and then they have to buy package policies of other kinds. And there is usually, as the business gets larger and more complex, then there's usually a separate limit, separate time coverage, separate deductible, and that can be bought without too much trouble, except for the fact that the agents and the insureds that are purchasing it need to work through and agree on that ahead of time so everybody knows what's available and what they can do. We certainly believe there's going to be a lot more widespread interest in that now, pandemic related or not, as far as the business interruption. But part of it becomes based on how much time they think they might be shut down, and what is that cost to them for that coverage. It can be fairly inexpensive, but it can be fairly expensive.
I had a question. At any point, do you know if the National Association of Insurance Commissioners have been looking at this issue of business interruption insurance? I know they're going to be meeting in April. Not sure if it's going to be in person or if it's going to be remotely. But obviously, with so many of the insurance departments having to work with our governors and others, has this been something that has been brought up with the National Association of Insurance Commissioners?
Well,
this is Don. Go ahead, Tim.
The answer is certainly yes. The NAIC is paying attention to this. I mean, one of the first things I saw from them was back in March of last year, where they warned us against the issue of trying to impose retroactive coverage. But more so, and more recently, the Center for Insurance Policy Research, which is an arm of NAIC, did a terrific webinar on the topic of business interruption insurance, and a number of industry and legislative reps were there to present. It was a very good session.
Excellent. Representative Peterson, you had a question?
Yeah, there's one more question that came in on the audience chat, and then I'll turn it over to Representative Brian Patrick Kennedy for closing. And that question was, are there other alternatives to BI insurance or pandemic backstops to helping businesses who have suffered during the business closures?
It's a tougher question. Obviously, some of the funding that the federal government has done in the last year is an alternative. It may not be considered palatable, but it has been relatively efficient in getting money out fairly quickly. I'm not aware of anything else beyond that, though.
This is Don Griffin as well, if you would. I think that the government program, as I mentioned earlier, I think the policyholder, or I keep wanting to call it policyholder, the Paycheck Protection Program that was put in place, I think we need to look at, and it had faults, as most legislation does when it's done in a hurry because it had to respond to this. But I think as we move forward with the new administration and new Congress, we as an industry are really trying to figure out, because we had come up with a program, and most of the programs that have been developed are based on some definitive point or declaration by someone that they have to shut down, or they can be partially open, or they can do this in various ways. We're thinking, based on what we've seen from the economic impact, that that's not really the best trigger. But there needs to be some financial mechanism to get get money in the hands of these businesses, and it needs to happen quickly. So when we look at this going forward, and we're going to work with members of Congress, as I'm sure Leon and Richard will too, as far as providing independent thought, that there's got to be something that can be done quickly. And it needs to be done even if it's only done for 3 months or even 6 months. Now we're into a year, but certainly 3 months is critical for most of those small businesses to see whether they can survive. And at the end of that 3 months, many of them can make adjustments if they need to. But surviving that first 3 months following something such as widespread as this is problematic. And that needs to be, I'm hoping that needs to be the focus of the federal government program, is something that would react quickly. Thank you.
Good. It looks like New Jersey has been one of those states that has had a lot of legislation introduced, and it looks like there are several others. As Heather pointed out on the audience chat, NCSL does have that list of pieces of legislation that have been introduced. Have you seen any state at this point in time pass anything, or has it mainly been in discussion as far as retroactivity for business interruption insurance, or to ensure, because I know in many cases some businesses that did purchase business interruption insurance, the insurers have gone back and not honored that particular thing because of a pandemic. So have you seen any state in which business interruption insurance, that they passed anything that has been substantial?
Representative Kennedy, this is Don Griffin again. I'll take the first stab at that. We have not seen a retroactive bill pass at all. I think most of the states have realized, and most people, when they start to look at the actual numbers, have realized that that's just not something that's going to help, because it's going to put other insurance products in peril. We have seen Illinois, which I'm part of right at the moment. I've lived in various parts of the country, but I've lived in Illinois for the past 20-some years. I can say Illinois passed a study bill where they're looking at trying to figure out what they could do. But I think from our standpoint, and I think Leon made a comment that he kind of supports this, and I believe Richard pointed out too, is the magnitude of this is just so large that it's probably going to take a federal program and a prospective federal program, not a retrospective, but a prospective federal program to be able to absorb this kind of event, because there's just state legislatures, unfortunately, and even the federal government, other than the fact that we can go into further debt as a government. But even then, there's got to be something much larger than the states and even municipalities and other places that have all looked at this as a way to try and solve it long term. It's just not palatable otherwise financially. Thank you.
Excellent. Well, it looks like we are drawing close to the end of our time. I wanted to thank Don Griffin, the Department Vice President at the American Property Casualty Insurance Association, Leon Buck, Vice President of Government Relations at Banking and Financial Services for the National Retail Federation, and Richard Gibson, Senior Casualty Fellow at the American Academy of Actuaries, for your time today, for your presentation today. Thanks for sharing your expertise on this. I also want to thank our audience for taking the time to participate in our webinar this afternoon. The archive of today's webinar will be posted on NCSL's website in the next few days. To find the archive, you have to go to www.ncsl.org. With that, I want to thank my co-chair for helping to run things while I work through the technical difficulties of this new webinar type system. It's a little bit different than all the other ones that I've been on. And with that, we wish everyone a great day, and we are now adjourned.
Thank you.
Thank you.